Wealth is much more than just about what you have in the bank account.
But really, it comes down to having like just buying time, like buying
Yes.
time for you to be able to do what brings joy to you and your family.
I can't take no loss. I don't even know what it costs. I hit the ground and I go.
All right, just like you, Nate and I both listen to other podcasts. MFM has been one of my favorites for years, and I always really enjoyed the episodes where either Sean and Sam, when they talk about their exits and what they go to invest in, or when they bring on other founders or folks, business folks who come on the show and share what they're doing and thinking about investment wise and what they're doing with their money. I always got a ton of value out of that. And that in combination with, that's also been one of the most common questions that at least I've received, Nate. I don't know about you, about like, hey, what are you doing? What are you doing with your money? What are you investing in? What next business are you starting? So we thought we would take this episode to pay it forward. We're 5 months into or 5 months past the exit closing with Elevar, and thought we'd just share a little bit behind the scenes on, yeah, what are we doing? What are we thinking about? What actions are we taking? What actions are we not taking? And hopefully you get as much value out of this as I have from these other podcasts I listen to for inspiration.
Yeah, we've gotten some great advice along the way to help guide and kind of create some guardrails for, who are you as an investor? What are the best areas to invest in? And based on your personal experience and your background, what specific categories are going to be best for you to put your money in, because there's a lot of ways to get rich and go broke based on who the individual is. And I think that's something for sure we've learned over the first 4 or 5 months here as we're trying to get settled into, how do we start to build wealth and structure this in a way that's not filled with risk. And it's also going to be a great outcome for us to create some passive income and create that lifestyle that, isn't totally dependent on, going to the office or working day in and day out to earn money like we've been accustomed to up to this point.
Yeah, and for the record, I think I've met more people who are not founders and more leaders of different teams, companies they have more financial independence than founders do. So this definitely is not a founders only conversation. That's just the way I describe myself, and so that's the term that I use. But yeah, this applies to anyone. So Nate, I'll kick things off here. One of the, to date, 5 months in, I think the best advice that we received from our executive coach was, this was the call we had, I don't know, January 20th. And it basically was like, he said, hey, you are going to experience a lot of new emotions over the next 1-2 years. The best thing that you can do is have a default no to everything. Every investment, every family member that comes to you, whatever comes up, your default is no for a minimum of 6 months. And just put it into something safe that is 100% safe. So whether it's a high yield savings or T-bills or a mix, and this is not financial advice to anyone, but basically just default no and just put it somewhere safe, and know that especially now with interest rates, the returns are 5% or so. That is still investing your money, even though you are not writing checks and magically turning into an angel investor. So Nate, that was, for me, that was the best piece of advice that I've followed to date. What about you?
Yeah, I think it was what Eric taught us is to not have this sense of urgency that, day 5, you've got to have this incredible diversified plan. It's like you said, put it in something very stable, and then start to become very educated on the different areas, opportunities, industries, and categories of investment. That's basically been what my last 5 months has been. The day that we got the transaction transfer, it went straight into a money market account, and it's just been sitting there. I haven't done anything else other than just try to learn and consume as much information as I could, because, up to that point, I wasn't thinking about all the different nuances of being an investor. We were running businesses and trying to, grow a business month to month, instead of thinking, how are we going to go into a different S&P fund or whatever else. So
You got to have
that
money to do that. You have to have money. You have to have liquid
exactly.
money to do that. So yeah, last time I was trading stocks was in mid 20s, I think, when I was trying to make money to buy my wife her wedding ring, which did work. Apple and Google paid off for me with that.
Yeah. Yeah. So Eric gave us a lot of great advice on that front. I do think it kind of set us up for success to not have this sense of urgency. And that, for me, I have this Apple Note I just showed Brad off air. That's at the very top of my note here for wealth management. I have my principles, and they're my major goals, and they're the major characteristics I want to define me as an investor. And that's going to be different from every person, but patience is one of those things that they talk about on MFM a ton, but it all leads back to Warren Buffett and Charlie Munger, who in that specific area of life they are very successful in. And they talk over and over again about just being patient. Like, you don't have to rush into this. You don't have to, run and jump into that real estate deal just because you have a buddy who seems to be doing well in it. Like, know why you're getting into something, have some expertise and some experience in that field, and then make a move when you feel like the time is right versus feeling like, you're a FOMO type of investor.
Yeah. The other piece that's really stuck with me is knowing the concept of an investor DNA, which I don't know if Garrett Gunderson coined this or not, but that's where I picked it up from. But knowing your investor DNA. So, for example, do you love real estate or do you hate real estate? Just because you might have enough money to put into real estate doesn't mean you need to be a real estate investor. Do you love the stock market, or do you not enjoy checking the market at 9 o'clock and 4 o'clock every day to see if you're going to be happy or not? Do you like starting businesses? Do you like being an angel investor? Whatever it might be, there's a million options out there to be, to find your own investor, but truly understanding what my investor DNA is, which could be for me, it's very much, I don't really have an interest in stock market or angel investing. I like building businesses. I like learning new skills. And I like real estate because it's stable and I like living in houses. And outside of that, it's very much a safety. I'm the risk. Like, I don't want to incur a lot of risk in my life right now. And so that for me is just, I love the 5% automated. If I know that's guaranteed for X number of months, years, whatever it might be, I'll take that versus maybe getting 7 to 8% return if the stock market performs for the next X number of years. But that's just, again, that's where understanding yourself, you are unique. So I'm very unique in what my vision and perception of the world is, and Nate's is different than mine, and yours is different as well.
Yeah, and if we can get into talking about resources, where are we going for our education? Where are we going for advisement? Brad, I know recently you're evaluating a real estate investment, and you had a really cool way of having some assistance in evaluating that process. So what did that look like for you?
Yeah, so I live in Charleston. The house we are currently in, we've lived here for 6 years. It's on a tidal creek. The house we had before this, I bought as a short sale, I don't know, 11 years ago. Same creek. So if you zoom out from Charleston on the map, you're going to see there's water everywhere. So there's a tidal creek that feeds out into the Charleston Harbor, one of probably thousands. So we did well in that first house we bought as a short sale. Used that to basically trade up to this house, which was farther up the creek, where it could just have more access to water. It's a neighborhood, so we are thinking about having kids at that point in time. We didn't have any, and it's performed very well. It's appreciated more than the average in Charleston has. And ironically, our next door neighbor, who it's currently, there are renters in there, but they put it up for sale. And it's like, oh, this is interesting. That's great. There's already renters in there. Should I evaluate this? Because going back to the 5% money market, that's not going to last forever. Rates are going to change. So how will this work? How will depreciation help offset taxes? What are, like you said, the learning, like, what do I need to do to evaluate this option? Because this particular strip that we're on has performed well for our family in terms of housing and real estate appreciation. So to answer your question on what I did for research, I went to Claude and ChatGPT and I communicated. So I gave context on, hey, this is who I am. This is my situation. This is my scenario. Here's who I want you to be. Here's how I want you to act. And just started to have the conversation like, hey, what are the average appreciation rates in Charleston for the last 10, 20, 30 years? Hey, what's the average stock market return for the last 10, 20, 30 years? Okay, in 2008, when the bubble happened, pulling out those nuances or those variables, then it was, hey, there's these reports that the water table is rising and seafront homes or properties on water will no longer be around. Okay, do some research on that. And so I just kept pulling all these strings out of Claude and ChatGPT to help me understand and evaluate this opportunity that popped up. So I'll pause there just so I don't go on a 10-minute rant about all my questions to ChatGPT and Claude.
Yeah, but those tools are such great resources, and we talked about this off air. A lot of times you're either on the clock when you're asking a financial advisor every question. So there's a dollar attached to that. And a lot of times they're steering you, knowingly or unknowingly, steering you into an investment area that's going to produce the best benefit for their firm. So I really like going to GPT and these other AI tools because I feel like I am getting a crowdsourced, unbiased feedback loop on just what the open internet is saying. And I like to
Mm-hmm.
start my search there. Like I had an attorney update a contract the other day, and I was able to go to him with some very specific feedback because I just dropped a couple of agreements into GPT and said, "Hey, give me some feedback here. Where do you see some vulnerabilities?" And it was even identifying the state that I was organized and operating in and making recommendations based on the laws in that particular state. That's completely for free. So I thought that was pretty
Yeah.
incredible. As far as resources go for me, so far I've probably spent the most time between Eric Speet and Garrett Gunderson. So Garrett's book, Killing Sacred Cows and What Would the Rockefellers Do? What would the Rockefellers do? If this feels like a meaty conversation, what would the Rockefellers do is like a 501 level conversation in my mind. But
Yeah.
what he identifies there is there's 6 or 7 main areas to build wealth. So one is tax strategy. And if you're not working with a CPA who, I want a CPA who's obviously legal, but I want one who's also going to help me like come up with some creative strategies to have more like tax efficiency in my businesses, the way I expense things. Do I pull some personal expenses underneath the umbrella of my LLC? Do I break apart things? There's all kinds of different strategies there. And, if your CPA is only filing your taxes every year and that's it, like you're doing yourself a disservice because you can save so much money in that area. Intellectual property, that's a second area, which is what we're doing right now. We're creating content. This is our IP. We're going to create blogs from this, whatever you have in that category, in that vein. Real estate, which, Brad just said that he has an inherent interest in real estate. I have a long background in real estate and will definitely be working in that area for many years to come. And for sure,
There's different nuances. Sorry, finish up and I'll interject.
yeah. So for me, I'm going to be more in multifamily and hospitality. So I'm trying to buy properties that have the most doors on a single acre or single piece of property. I've
Yeah.
definitely looked into the storage unit game a little bit from Nick Huber, but the one opportunity I looked at in that, it was just too many storage units within a small area. So that didn't work out. But I'm definitely keen on storage because you can operate, 500 storage units with one employee. So that's like the scalability I like there. And it's a pretty repeatable process from property to property. Insurance structure. This absolutely blew my mind that there's cash flow insurance and the differences between term insurance and permanent life insurance. I had no
Yeah.
idea about the
Okay,
difference
whole life.
there. Yeah, whole life. And like once you pay into that permanent life insurance plan and the cash flow insurance, like those can work just like a bank, but they have better loan terms and interest rates. And you also get that cash so much quicker because there's not so much time required to underwrite and say, what is Brad's debt to income ratio? What are all these other variables? Should we loan him money? And, banks, they have certain categories that, they can only put 10% of their funds in multifamily or commercial, whatever. So there is so much nuance there with insurance structure. And Garrett's book, honestly, that's one of the things he's most known for with What Would the Rockefellers Do? The insurance piece and how smart he is at like developing wills and all of the nuances around that. So definitely check that book out. It is definitely worth it. Obviously, stocks, we talked about that, and crypto. Those are
Let's wait. Let's unpack whole life a little bit more
okay.
because just to go a little deeper on these. I agree that that's still an area that feels a little too good to be true.
Mm-hmm.
And just for context, I knew zero about whole life insurance before 5 months ago, so knew none. During the last 5 months, had a chance to sit down for half a day with somebody who knew everything about whole life insurance and just unpack and learn what. Just to describe what Nate was going through, this is my perspective and my somewhat aha moment of yes, you right now, instead of just putting your 5% into a money market, for example, you can choose, okay, let's put instead of putting $1 million here, we're going to put have $1 million whole life policy. And that would be, so you break out payments paying into that over 7 years or 10 years, whatever the payment is. And once you start paying into that, so if you are paying whatever, 1 million divided by 7, I'm not going to do math, but call it 150,000. So once you start paying 150,000 or whatever that number is per year into this, that is like what Nate said, that is now a bank account. So let's say you get to the point where you have $500,000 over X number of years in this whole life cash policy account. You can then take a loan out to yourself. So you can take a loan out for a $500,000 to use for a down payment on a new home. So let's say on the house next door, if I didn't want to pay cash and wanted to do a mortgage, or whatever you want to invest in, you pull $500,000 out, or it's for school. So now that policy, so normally you'd be, if it was a normal bank account, you take a $500,000 out, you will no longer collect interest on that. But in whole life, it's like that money is still there. So you still get that full 5 or whatever the interest rate is when you lock in the policy. You still get 5% on that amount that's compounding, even though it's not there, because you've taken it out as a loan. So your loan might be 4% or 4.5%, but that money is still earning 5%. So it's like free money. So it's like a free money loan, and then you can choose to pay it back over time, or if you choose to just let it go, then the death benefit of that policy, which is greater than $1 million, let's say it's $2 million, the death benefit, like when you pass, would pay back the loans first, and then distribute the remaining to your trust holders or whoever is on that. So that to me was like, wait a second, I'm not signing right here because I need to learn a lot more about this, but
Yes.
it's pretty wild. And I've spoken to some customers of Elevart. I was talking to a couple guys at the summit, and because they're asking me like, hey, what are you doing? Now this happened. I was like, I don't know, thinking about this. I'm like, oh, we just did whole life and we love it. And so it is a new world, a lot of opportunities, which for me is scary because I'm very naive in this, because I had $1,000 in my bank account for 30 years,
Right.
20 years.
And same for me. And then the other piece for these cash flow insurances and the whole life insurance, they're very tax advantaged as well. So I have all my money right now in money market that's generating 5.15% interest. This is as of May 2024. I'm getting taxed 30% on that interest rate every single month. So yeah, that's great. That's generating a ton of interest based on what normal money market accounts are based on history. But I'm going to have to turn around and pay 30% to the government for that. So that's another reason why this insurance, which I never thought I'd ever say, this insurance becomes exciting. But the tax advantage for that is crazy. And then the other, I guess, final thing I've got on insurance at this point in time is whatever company you're using, make sure it's a privately held company. So these publicly traded insurance companies, they're a completely different policy and the way they can operate and the risk structure. So that's another piece is I believe Mass Mutual might be one of the better ones because they're privately held. They're not beholden to any board or shareholder that they have to like make their decisions upon. So apparently that like really expresses itself out in the way they structure their policies and how much lower risk they are compared to banks, which we've seen, in the last year. Banks can close in a 24, 48-hour period and you are cooked. With that in mind, the money market account, I don't know how you have yours structured, Brad, but I have mine set up where I have one bank that distributes and handles my money to all different banks. So there's not any more than $250,000 in a single bank, because as we saw last year, if there's a run on a bank or they have very poor practices or something changes with like the T-bills and you don't get to that bank or call them in time, like they don't have to pay you any more than $250,000. And if you've got $10 million, $20 million in that bank and that single institution, you've just lost that money. And that would be absolutely devastating for anybody listening to this, of course.
Yeah. Yes. And currently Wealthfront, and that's saying it's distributed. I think it's up to, I don't know, 7 million or something like that, but it's distributed out to X number of banks based on that 250 amount. And I think it's pretty common. But if you're at Wells Fargo or Bank of America, maybe you don't have as much risk as the Silicon Valley banks, because if they're going under, then there's likely something significantly worse going on in the U.S. At least that's what the guy at Bank or Wells Fargo was telling me when I was asking him about this. Like, hey, I see your account is only FDIC insured up to X amount, and he's like, if we go under, there's much bigger problems if Wells Fargo is going under. But anyways. Where are there any other opportunities? So a few episodes in the past, we talked about talking to different folks about founders, about taking on angel money and looking at doing different deals. But yeah, what sort of deals or opportunities magically presented themselves to you in the last 5 months where you've never seen or potentially spoken to these folks in the last 5 years?
Yeah, definitely have a lot more opportunities like that, and that default position of my money's already been allocated, I'm not making any investments at this time. That's been a great way for me to not personally reject people, but I'm just going to turn down the investment opportunity this time. That's been a great way to kind of facilitate those conversations. One key focus of mine at this point is, I'm not scared of structured debt, and I want to make investments that are going to create monthly cash flow for me. So I'm not going to invest, for instance, in a piece of land that doesn't have any ability to generate cash flow month one, or we aren't building something on it actively to generate monthly cash flow. I'm not looking for long-term plays. Elevar for sure was a long-term play. You talked about Seth Godin talking about 7 years, I believe that was the guy. So my personal financial guiding principles are like number one, 1A is cash flow is king. So I'm trying to structure my investments and my portfolio and whatever I do around one, things that I know. So I'm not out here just throwing spaghetti at the wall. And also, how is this going to generate cash flow day one? And I have a monthly cash flow goal that I have by 2027. I'm not going to share what that is, but I just want to continue building that monthly recurring cash flow, because that monthly cash flow is going to be able to allow me to pursue other investments. It's also going to work as a filter for me and a litmus test to say, you know what? Yeah, that piece of property is great, or this company is great, but there's no ability for me to quickly start earning money on that.
Mm-hmm. That's probably a little bit unique in at least the world, that in my little bubble, where you have different companies that'll exit, SaaS companies that'll exit, and then employees of that company or the founders, or it could just the business doing great and employees accumulate quite a bit of wealth, and then the investor title shows up on LinkedIn, and then you see them start doing more angel deals, angel investments with other SaaS companies. So I think your angle of cash flow from day one is unique.
Yeah.
It's probably great for some and not so great for others, because it doesn't potentially have that huge home run, the 100x, Uber, 1000x, whatever it might be. But chances are we're not getting into those type of deals now
No,
anyway.
and I,
So
I think it's totally fair that a portion of your pie can be dedicated to businesses. So, I'm still interested in Elevar, and I want Elevar to do great. But I'm just not making any other plays right now that are like big what if plays. And real estate for me, I read at some point a couple years ago that 90% of all millionaires have been made through real estate. And the entire economic structure for lending and everything is based on physical assets, tangible assets, and real property. So I've just always seen that it's easier to say, okay, this property got appraised. Bank or lending institution is going to offer me structured debt that I can, pay down every month, have a margin on top of for personal cash flow and distributions every month, versus angel investment required for businesses because there's no collateral to put towards, that business. So yeah, as time moves forward, 5 years from now, whatever, for sure, I'm going to dedicate a portion of my pie to more exploratory or angel type moves. Back to your investor DNA, I don't know a lot about being an angel investor and how to structure those deals and what that looks like, what the due diligence process looks like. So there's a lot of learning that has to occur on my side. I'm thinking 3, 5, 10 years, probably 3 to 5 years for me to actually become an investor that can bring not just money, but some great knowledge to a company that I'm going to invest in and help them accelerate growth.
yeah. The other part about the last 5 months for me that stood out is ultimately we're all of us, we're all chasing some financial dream or outcome to retire, the quote unquote retire early, or to be able to work from wherever you can in the world, which that comes with having a flexible employment agreement or company that you own. But really it comes down to having like just buying time, like buying
Yes.
time for you to be able to do what brings joy to you and your family. And that is one that if you would have told me that last December, November, December, I would say that's BS. Yeah, I think just that is a learning that I've struggled with. There are others, probably majority of the world probably do this better than me, but man, I think just time, like just having time to do what really brings you joy is so
Man,
important.
I can't agree with that more. I've got the same car I had before the transaction. I've got the same house. I wear my $8 t-shirts every day.
We did match today. Both got the black
Yeah,
tees going.
and except you're the tan version. but that has been the biggest thing for me too, is that I have blocks in my week now that say my kid's name, and I'm not going to miss that. And then every 2 weeks, well, I mean, we sat down with Gary Gunderson, like a large portion of the conversation was really focused around, how are we going to have more time with our spouse and developing those date nights. And, a lot of it came down to just structuring a recurring sitter. And, for
Yeah.
me, wealth is about much more. I know it is for you too. So I'd say for both of us, wealth is much more than just about what you have in the bank account. And if your quality of life is terrible and, you've got all kinds of commas in your bank account and everyone thinks you're successful, so be it. That might be your path. But I definitely think I can speak for Brad and I both that, we would much rather be rich in time and availability, emotional and time wise with our kids and our spouse. And that is definitely part of this like wealth management. A wealthy lifestyle for me means, generosity, giving to others and also being more available for my kids because, we talked about this in other podcasts, but being a founder, it demands so much, not just from yourself, but from your family. I know, Brad, you as well, like we both have missed time with our kids and family that we definitely want to get back and continually to pour into, moving forward from here.
Yeah. Yeah. We tie this back to the perfect exit episode that we had. The worst business, in my opinion, that you can create and was our lives, or at least my life for a few years, was a business that you turn into a prison to yourself, where you are a prisoner of your business and you don't have any way out. And it is very easy to fall into the trap as a founder that just grinds and GSDs, where you build your own prison and you are miserable and you are all the things that you just mentioned around time, family. And so be cognizant of that. And that's why sharing some of these just somewhat random thoughts of, okay, what are we feeling like post launch or post exit? What did it feel like pre exit? What did we learn about perfect exits? And tie this together to, again, trying to give you the seeds, if you are thinking about this yourself, the seeds that can prevent, I don't know, some of the places that we ended up building or trapping ourselves, or some of the trap doors that we end up building. Not a trap door, a prison without a trap door. I don't know where I'm going with this, Nate. You got to help me out here, but you get what I'm
And
saying.
what's coming to my mind is that lesson you challenged me with that you learned from Dan Martell. And this was before exit, before acquisition. We were sitting in that prison that we had built for ourselves too, with this company and our commitments. And it was, okay, fast forward mentally to that time when you've sold your company, you've got all the time in the world, you've got the means to, pamper yourself or do the things that you've always withheld. What's one of those things that you can reach out into the future and bring back to your present and start doing those things today? Because not everything that's great in life has to come with a price tag. So, those calendar reminders for my kids at 5 o'clock on Tuesdays and Wednesdays, and then date night on Thursdays with the wife, those things don't cost money. Those are things also that are going to build lasting memories and value that, those things are going to trickle down to generations as well. You're not just passing money down to your kids, you're passing your habits and your wisdom and your lifestyle choices. So those are some of the big things I've seen every Friday, every Wednesday at 5 p.m. My daughter notifies me before Google that we had that date night. And that's been a huge thing for me. Yeah.
Nice.
And I mean, you definitely challenged me with that, because when we were looking at our calendars with Eric one day, you had your pre-scheduled blocks with your boys. And I was like, I'm going to do that right now too.
Yeah.
And like throwing that rock in the river that your week is going to like work around that, like, okay, I'm going to have this time with my family and the people that mean most to me. Like those are things that are free. You can start doing today. And once you get past that acquisition and that exit, those relationships are going to be stronger and more intact, so that you can like share that great outcome and that big win with those people that like you've brought along the way.
Yeah. Yeah. One other unrelated comment I have to this whole process is, obviously I'm still at Elevar and Elevar Buxton, and it's funny. I was just thinking I've had more customer research calls in the last 2 weeks. Not I'm going to say in the last more than I've had in the last 2 years, but it's probably not accurate. But I've spent more time talking to customers about future facing problems, needs, aspirations, and that goes back to the time. Like I just have more time to do things now in the world of Elevar that I didn't have 6 months ago, because I was still CEO and CFO and trying to make sure the train stays on a track. And so if for you as a founder, as a business owner, if you are one of those, is when you do go through this process and choose the right partner. Because again, everyone's different. You could be like, hey, I just want to get out because I'm going to go move to Australia and I don't know, do whatever, or I'm going to move to Costa Rica and go surf. That's great too. But if you are a builder and you're like, hey, just want to take some chips off the table, want to relieve some of that stress, but I still want to keep building, still love the product, love your business. Those opportunities exist out there for you, but it's on you to find the right partner to go to wed as you go through that process, because it does exist. Before we went through this, I spoke to other founders, and I think Eric even mentioned a couple that he had knew of where they'd had a transaction. It was backed by private equity, and he was like, yeah, the founder is like, he is the happiest person, literally the happiest person in the world, and he loves what he's doing, and he's been there for 2 or 3 years. So anyways, I think that's another angle. Exits to acquirers, whether it's PE backed or not, some can be amazing and obviously they can be terrible, but the diligence is on you, or the onus is on you to do the diligence on who that acquirer is, so you know what you're getting into.
Yeah. So to summarize here, whenever you're starting to plan what your future looks like, or how you're going to manage your wealth and grow your wealth, one great resource, initially go to these GPT tools and have a conversation, have those tools comb the internet and pull back some overviews and some triangulated opinions, so that, you can learn more about real estate, you can learn more about insurance, you can figure out, early on what your investor DNA is, so that you're not just out there throwing a little bit everywhere and you just feel overwhelmed. So understand that a critical part of building wealth is all the things that aren't financial in your life. So investing in yourself, your health, and the relationships with those around you, whoever those may be. You want to make sure that those relationships are going to help pull you to that acquisition table by giving you motivation and energy. And you want to make sure that those are strong as you move past acquisition. What else did I miss, Brad, as far as just a general overview here?
No, I think that's good. Is talk to others as well. So just talk, if you have the ability to reach out to your network or get introduced, of just talking to other folks to get firsthand feedback. I was thinking through the even us talking through, okay, what investments are we going to make? What's our investor DNA? Naturally, some of them might think, well, don't you have enough? Like, it isn't enough. And I'd say, yeah, that's a very valid question. So it's also fighting that urge of, okay, if you have $10 in your bank account, you think, how do I get, you got 20, how do I get 40? You got 40, how do I get 80? If you have 10 million, how do you get to 20 million? If you got 20, how do you get to 50?
Right.
100. So I do think having that internal conversation with yourself, and to me, it does go back to being clear on what makes you happy with family, friends, your network, your hobbies, etc. And for me, that guides the quote unquote investor DNA, because at that point, I'm not trying to build, and go public. And anyway, it's not going to go off that tangent. So I thought that was one nuance that has settled in a little bit with myself over the last 6 to 12 months.
I mean, that's all I've got there.
All right. Nate and I were chatting before we started this one. And again, in the beginning, as I mentioned about just some of the podcasts that we listen to and just getting the raw, like, hey, you just sold your business, tell us what you're doing, or how's it feel? What's great? What's terrible? So we thought we would just take that opportunity to do the same here. If you enjoyed this, or if you have any comments on what could make this better, hit us up on Instagram or LinkedIn. Love to hear your feedback. Otherwise, that's the episode. And share this with any other founders or folks that you think would get value from it.
I can't take no loss. I don't even know what it costs. I hit the ground, then it go off. Yeah, hit the ground, then it go off. Yeah, I can't take no loss.